Anybody with a home loan should brace for higher mortgage payments at renewal. Let's explore in this video why interest rates are going up in Canada, its cooling effect on today's hot housing market, possible increase in mortgage payments by 30% when they come up for renewals, effect on other asset classes, and at the end, my perspective about all this. Hi, my name is Sunny, and I make content that affect a common man financially. So let's dive into today's topic, mortgage payments going up. If you're new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which of course will be highly appreciated. Any increase in interest rates can be very unpopular, but there is a financial rationale why Bank of Canada is doing so. Let's see what Bank of Canada's governor has to say about this hot topic recently.
The economy is overheating. You look at our labor market, we've got almost 1 million vacancies in the labor market. The economy is in excess demand. We need higher interest rates to take out the excess in excess demand, bring demand back into supply to get inflation down. Part of that adjustment will no doubt come through the housing market. That's part of getting inflation back to target.
We all witnessed ultra low interest rates during pandemic times when Bank of Canada was trying to stimulate economy as we had countrywide shutdowns. That was one of the contributing factors why we have rampant inflation right now, which they are trying to control. During its financial review, the central bank is of the opinion that elevated house prices as well as debt tied to it makes the system more vulnerable, especially when interest rates are going up. During pandemic, when interest rates were ultra low, house prices increased by almost 50% nationwide, but people could still afford a relatively lower mortgage payment. With interest rates now going back to more normal rates, 1 out of every 5 Canadian households could find themselves over-leveraged, which could be a concern for the banking system. According to a recent survey, debt-to-income ratio of such overstretched households have reached 350% or more, which means that increasing interest rates could inflict much more financial pain for them. Under such a scenario, there is only one variable that has to go down, which is the cost of home ownership here in Canada, so that a typical household income, cost of home ownership, and mortgage associated with it all has to make financial sense. According to Bank of Canada's assumptions, variable as well as fixed loans in the next 5 years will be around 4.5%, which will represent about 2% increase in the interest rates from where they are right now. In plain English, it means when homeowners have their mortgage up for renewal in the next 5 years, they can expect their mortgage cost to go up by about 30%. Real impact in dollar value will depend upon factors like the borrowed amount, the duration of it, as well as the type of interest rates, fixed or variable. Now, if you're already overstretched financially, think about a scenario if something happens to your source of income or face sudden monetary emergency, now you might find yourself in a big trouble. Our modern day economy is based on the interest rate set by Bank of Canada. That is why its up and down movement has got a cascading effect on our financial lives as it affects the value of assets that we own. In order to clamp down on rampant inflation, bank has begun increasing interest rates. As a result, all assets are bound to go down in value. Now, this reduction will depend upon the type of assets you have, which can range from manageable to catastrophic value destruction. If you look at major indices in North America, they are all trending downwards, whereas speculative assets like cryptocurrency saw a dramatic value erosion. We are still facing supply chain issues, whereas recent Russian invasion of Ukraine has complicated the situation even further. As a result, Western world has put in sanctions against Russia, which is a major exporter of commodities and fossil fuel, both of which increases inflation even more. As the central bank is trying to control inflation, hence there is a possibility that interest rates might go up even more in the future. In today's inflationary times, we can expect increasing interest rates in the short term. Hence, you need to put in that extra effort in researching and analyzing the type of assets you want to own during these tough times. I completely understand that for most of us, owning stocks or real estate has been a good experience until now, but these are extraordinary times. In my limited wisdom, there are two best asset classes to own, but what we buy, where we buy, and at what price makes all the difference. I hope it makes sense as I'm just a random guy on YouTube having an opinion and not even a financial advisor. So please consult one before investing. If you have found value in the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.